Crypto, stocks, or real estate? Which one is the best investment? If you ask Michael Saylor, he'll say go crypto. Warren Buffett would say buy stocks, and Donald Trump would say go all in on real estate. But what's right for them might not be right for you. Over the last 5 years from the time of me recording this video, Bitcoin is up a little over 1,000%. The stock market is up a little over 120%, and the housing market is up about 50%. But here's the catch. Past performance does not indicate future performance. So the question is, what are we going to see over the next 5 years? And this is where things get interesting. Crypto is by far the most volatile, with the biggest swings up and down. The stock market is the easiest place to start, and it has proven the test of time. And real estate comes with the best tax breaks. Plus, you get to own a hard asset that you can see, feel, and touch. And that's why today, I want to help you break it down. As somebody who's been investing in cryptocurrency since 2017, and as somebody who's been investing in stocks and real estate for well over a decade, let's break this down into bite-sized pieces. That way you can come up with a better strategy for you. Let me start with real estate because it makes up the largest piece of my portfolio outside of my business. And the name of the game for real estate, the first pro, is that the game is cash flow. So if I go out and I buy this house for, let's call it $250,000, which yes, it is possible if you're willing to put in some work. And now I'm gonna rent out this property to somebody else. Let's say I rent it out for $2,500 a month. If I do it correctly, this rental income will pay for all my expenses, my property taxes, my insurance, my maintenance, my management fees, my vacancy costs, my mortgage if I have one, and then put some money in my pocket every single month. That's the right way to do real estate. Now, if you're thinking, but Jaspreet, I don't want to be the person that has to unclog toilets at 2 in the morning. Trust me, I don't either. That's why you want a manager, a property manager, who's going to manage the property, do all the day-to-day stuff. That way it can be relatively passive for you, and that's factored into the cost as well. So the number one goal is cash flow. Then we have pro number 2, which is appreciation. Now, real estate is very localized. Some neighborhoods are going to see way more appreciation in price than others, while other neighborhoods are going to see property values fall. Just like anything else, it is localized. Some assets will do better than others. But if you're buying property in a good area, the first thing that will happen is more people want to live in that area. And if the demand starts to rise, then in general, the property values and rent start to go up. So now maybe this property is, let's say, $400,000. That's the new value of this property after a few years. It's a hypothetical, okay? If that happens, well, your rent will also probably go up, which means you get to make more money, but now you're sitting on an asset that's worth more money. Now you have a couple of options. Option number 1 is you can sell the property, and now you have this money in your hand, but you no longer have this asset. But the reason why some investors love real estate is because now you can do a cash out refinance, pull this new value out, buy another property, and the cash that you get in your hand, if you pull out $300,000, well, that's tax-free. And you can use that $300,000 to go out and buy more rental real estate that's going to make you more money, and the tenants are going to continue paying that mortgage for you. Pro number 3 is you own a hard asset. When you go out and you buy this property, you own the land, you own the bricks, you own the windows. So it's something that you can see, feel, and touch, as opposed to stocks or cryptocurrency, which is just a piece of paper that says you own this thing. Here you actually own the physical asset. And last but definitely not least are the tax benefits that you get from real estate. As a licensed attorney who's not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. Let me demonstrate. Let's assume for this example that I bought this property for $400,000 because I got a little excited earlier and I already crossed these numbers off. So I bought this property for $400,000. The first thing that the IRS says is I deserve a tax break because I'm buying a physical piece of property. And the way that this tax break works on single-family rentals, not single-family homes that you live in, only rental properties as an investor, is I get to take the value of the property, not the land, the value of the property, and divide it by 27.5, and that's how much of a tax write-off I get every single year. So let's assume that this $400,000 property is $100,000 worth of land and $300,000 worth of building. Now I get to take $300,000 divided by 27.5. Why 27.5? Because that's what the IRS says. But now I get a $10,000 a year write-off. So let's go through this example. I'm renting this property out for $4,000 a month. I gotta pay my expenses. I gotta pay for the property tax, the insurance, the property maintenance fees, the management fees, because I don't wanna be the one that's unclogging toilets. I gotta pay for the vacancy costs and everything else, even my mortgage if I have one. And let's assume now that after paying for all of my expenses, I am left at the end of the year with hypothetically, $15,000 of profit. This is how much money is in my bank account after paying for all of my expenses. Well, normally when you make $15,000 of profit, you have to pay taxes on $15,000, but this is what the IRS says. Hey, your property is 1 year older. So you deserve this tax break called depreciation. And now I can write off this $10,000 and say, hey IRS, this property is 1 year older, so I deserve this $10,000 write-off. And now you tell the IRS, I made $15,000, but I only have $5,000 of taxable income. You're only paying taxes on $5,000 even though you have 15 grand in the bank. And this is really just tier 1. As you start to get more advanced and you have a better accountant and you start to do more properties, what you realize is you can get a much bigger deduction. That way you make $15,000 and maybe you pay taxes on 0. This is called accelerated depreciation, which allows you to do a bigger write-off in year 1, 2, or 3. But that's a topic for a different video. So the first thing you get with these tax breaks is you get to make more money, pay less money in taxes, which is why a lot of real estate investors can make a lot of money and pay little to no money in taxes, and it's 100% legal. The second thing is if I buy this property for $400,000, I'm not gonna cross it off this time, and now it goes up in value to $1 million, hypothetically. Well, if I sold this property that I bought for 400 grand for $1 million, I have $600,000 of gains, which is great. But that also means I'm gonna get slapped with a big tax bill, unless I do something special. In real estate, there's something called a like-kind exchange. It's called the 1031 exchange, which says, if I take all $1 million here, I go out and I buy a bigger, nicer, more profitable property. It doesn't have to be more profitable, it doesn't have to be bigger, but if I take all $1 million and I go out and I buy another rental property, I can defer all of those taxes. I can buy this bigger property, and I can keep doing this until I die and never have to pay a penny in these capital gains taxes, as long as I own the property for longer than a year and it's a rental property. This is why real estate investors are able to take advantage of compound interest, because they keep buying bigger and bigger properties and never have to pay a penny in taxes as long as you follow the rules of the 1031 exchange. It has a lot of rules, so if that's something you're considering, get an accountant, get an attorney to make sure you do it right. But it's not all sunshine and rainbows, because there are some cons with investing in real estate as well. Con number 1 is the cost. If you want to go out and buy real estate, you need some money, period. I know a lot of people like to sell you this idea of no money down real estate, but no money down real estate has made me so much money, because a lot of people buy real estate thinking, I don't need any money, I don't need any experience, I don't need any credit. You're the first one to get foreclosed on, and then banks come to people like me to buy the property off of you for pennies on the dollar. So I am not an advocate for no money down real estate. You need money to go out and buy real estate, which is different than something like stocks, because you can start investing with as little as $100. Number 2, real estate also comes with more headache because you also are the operator. Yes, you can hire a property manager, but it's up to you to hire the property manager. It's up to you to make sure the bills still get paid, and it's up to you to make sure that this property is making money. Yes, you can hire people, but ultimately the responsibility is on you, because you are the operator in this property, which comes with more headache. And number 3, it's not liquid. If you wanted to sell your property because you need the cash, it could take 30, 60, 90, 180 days to do that. So it's not always the easiest to get your cash out of the property. And that's why real estate can be great for the right person. And you have to know the right investment strategy for you. Which brings me now to number 2. Let's talk about stocks. And this is where, if you are an investor and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free newsletter called Market Briefs every day, where we break down what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and it's completely free. So if you have not joined Market Briefs yet, what are you waiting for? I got the link for you down in the description below. Now let's compare that to the stock market. By the way, if you stick with me until the end of the video, I'm gonna show you what might be the best investment for you as well. When we talk about investing in the stock market, one of the biggest pros of investing in stocks is that there's a low barrier to entry. You can start investing in stocks now with as little as $100, even as little as $5, because there are a ton of online brokerages. So if you have a few extra bucks, you can start investing, and you can start investing in the companies that make whatever favorite products you have. If you like Amazon, you can buy the Amazon company. If you like Chipotle, you can buy a piece of the Chipotle company. And if you like the Apple AirPods, well, you can buy a piece of the Apple company. For as little as a few dollars, you can become one of the owners of the companies that you're spending money at. And now you're becoming an asset owner. Instead of just spending all of your money, you are owning the business that's creating those products. See, it's a mindset shift, and the great thing about this is you don't need a ton of money to start. Pro number 2 is you get to choose your income strategy. If you remember when I was talking about real estate, the name of the game in real estate was cash flow. I love cash flow. Other people will not. And so now when we talk about stocks, you can choose the game. You can choose to invest for cash flow, or you can choose to invest for growth. And they're two completely different investment strategies. Because when you're investing for growth, this means you're looking for companies that are not trying to make huge profits. Because if a company's making a huge profit, that means that they're not reinvesting all of their money. And if you're thinking about growth, you want a company to take all of that profit and dump it back into the company. Turn that cash into fuel on your fire to grow this company bigger, stronger, faster, and more market share, because that's how you're going to see the biggest growth in the stock price. And when you follow that strategy, you also don't have to worry about taxes, because if a company is not making profits, they don't have to pay taxes. So they get to use all of their money and then maybe use debt and other sources of capital to grow faster. And you don't have to worry about you paying taxes or the company paying taxes because you don't have any income. Versus if you're investing for income in the stock market, this means generally you're investing in a dividend-paying stock or a dividend-paying fund. What does that mean? This means that a company, say McDonald's, has billions of dollars of extra cash in their bank account at the end of the year. And then they might save a little bit, they might reinvest some back into the company, and then they say, we're already really big. We don't want to keep reinvesting more and more dollars, so we're just going to give this money away. We're going to give this money away to our shareholders, people like you who own one of the shares of the company. And then they give you a check. They actually just deposit it into your brokerage account, but this is a dividend. So every 3 months, meaning every quarter, you get money deposited into your account, which is great. This is cash flow. But here's the problem. When you get that cash, you got to worry about taxes. So you get to choose your destiny here in the stock market. You can choose to invest for cash flow. You can choose to invest for growth. Versus with real estate, the name of the game is generally cash flow. The third pro when it comes to the stock market is it is much more passive ownership on you. When you go out and you invest in the Amazon company, you don't have to go into the Amazon factory. You don't have to go into the Amazon headquarters, and you don't have to tell all of your friends to start shopping on Amazon. That's what the CEO, that's what the employees are working at. You are just an owner of the company. You don't have to worry about the management or the day-to-day stuff because they have the employees that are working day-to-day. When you invest in the company, you're just a passive owner. You can't tell the company what to do, although you can partake in the voting rights, because when you invest in a company, you get voting rights as well, but you don't get to tell the CEO what to do at Amazon or Chipotle or Apple. Versus when you own the rental property, you are the operator. It's up to you to fire the manager if they don't do a good job. It's up to you to fire a contractor if they're not doing a good job. All that now falls onto you, and you are the decision maker. But it's not all sunshine and rainbows with the stock market either, because you got some cons. Con number 1 is that investing in the stock market can be an emotional roller coaster, especially if you are a newer investor. When you go out and you buy a property, let's say you buy a house, and you buy the house at 8 in the morning. At 12:30 after lunch, are you going to go onto Zillow to see what the new house value is for your property? Probably not, because you know that this is a long-term investment that you just made, so whatever price swings happen in 4 hours probably don't make any difference. But when it comes to the stock market, it's a very different mindset. Because stock prices change every second, when you make a trade, people want to know what is the price 30 minutes later, 45 minutes later, 48 minutes later, 49 minutes later, and it can become this emotional roller coaster that if things are not going straight up, you can start to feel anxiety, you can start to feel stress, and if you start to see bad headlines, it can entice you to sell before you necessarily want to. Likewise, when you start to see all the news that say people are getting rich, you need to buy before everybody else gets rich, it can entice you to buy. I mean, maybe you shouldn't be. Con number 2 is that a stock is a paper asset. When you buy a share in McDonald's, you are essentially getting a certificate saying you are one of the owners in the company. But you don't actually own any of the franchises, you don't own any of the burgers, you don't own any of the bricks, you just have a contract that says you own a piece of the company. You can compare that to something like real estate, where you own the bricks, you own the windows, you own the doors, you own the land, you own the physical property, versus in stocks, you just have a contract that says you own something, and if that company you invested in, like Amazon or McDonald's or Apple, goes bankrupt, well, chances are you've lost everything. Versus with real estate, you have more control, and if you start to run into financial problems, you can sell off things. I mean, you can sell the property, you can sell the land, you can sell the windows if you needed to. Although if you're selling off the windows in your rental property, you're probably in a pretty rough situation, and that's not going to solve any problems either. And then we have cryptocurrency like Bitcoin, and the first pro is probably the most obvious, which is there's a ton of potential upside. Because cryptocurrency is still such a new asset class, a lot of people are still scared to invest in cryptocurrency, a lot of people still don't really understand it. And more countries are starting to adopt it, so if it continues to grow in adoption, well then you could see a lot of potential upside. Pro number 2 is this idea of cryptocurrency being borderless and decentralized, because now if I bring cryptocurrency in the United States and I put it in my cold wallet, meaning to my USB drive, I can fly to Mexico and I could take my cryptocurrency. I can go to India and use my cryptocurrency. I can go anywhere over the world. And my money, my cryptocurrency can go with me and I can spend that money in theory. It's not the same with stocks and real estate, because with real estate, if I had to leave the United States, which is where my real estate is, well, my real estate is not coming with me. Likewise, if I wanted to take my stocks to a different country, that runs into a lot of financial regulations, and I'd have to sell my stocks in the United States and then take that money somewhere else. So it's not as direct. Pro number 3, which some people might consider a con, is a 24/7 access to the cryptocurrency market versus the stock market, which is not open 24 hours a day for everybody yet. Yes, there is some after hours trading, some before hours trading, but that's not really very accessible. But in the cryptocurrency world, it is 24/7. And last but not least, number 4 is that with cryptocurrency, again, like stocks, you don't need a ton of money to start. You don't need $10,000 to start investing in cryptocurrency. You can start investing with as little as $10. But just like stocks and real estate, it's not all sunshine and rainbows with cryptocurrency either. In fact, cryptocurrency is the most volatile. Between 2017, when I started investing in cryptocurrency, and today, we have seen a number of market crashes in cryptocurrency, way more than stocks, and we really haven't seen a market crash in real estate over the last decade. The last real market crash in real estate was during the 2008 financial crisis, but with cryptocurrency, there's been a lot of crashes. Con number 2, cryptocurrency has the highest risk. Number 1, it has not proven the test of time. It is still a very new asset class. Number 2, we don't know how well it is actually going to be adopted and if that adoption is going to stay. And number 3, well, there's a lot of uncertainty. This speculative nature makes cryptocurrency much more risky, which means you can make a lot more money, but you can lose all that money just as fast. 3, there's a lot of regulation concerns and risks. Right now, the Trump administration seems to be a little bit more pro-cryptocurrency, but the next president might not be. And because of how new cryptocurrency is, there's a lot of concerns as to how regulations can impact cryptocurrency, not to mention foreign country regulations on cryptocurrency, because this is decentralized, or is supposed to be. And because of that, what different countries do can impact the prices and stability and safety of your cryptocurrency. And number 4, there's generally no cash flow. Now, I get it, there are ways for you to generate cash flow on cryptocurrency, but in general, if you just buy some cryptocurrency, you're not going to get any cash flow out of it like you would if you bought a dividend-paying stock or if you bought a rental property. Now that we've laid the foundation for real estate, stocks, and crypto, let's talk about what's better for you. And this is where I got to remind you, I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Personal finance is personal, meaning what's right for me is probably not right for you. And so the best way for me to teach is just to talk about what I do. Not so you can copy what I do, because I don't recommend what I do to anybody else, but just so you can start to think like an investor. And for me, my largest investment is my business, Briefs Media, but we're going to ignore that because that's not a passive investment. After that, my next largest investment is real estate. It makes up around 50% of my total investment portfolio because my goal is cash flow. Because for me, when I think about wealth, for me, that means when I have enough cash flow from my investments that cover my expenses, I am wealthy because now I can live off of my cash flow, which is why I like investing in real estate. After that, after real estate, my next largest investment is stocks, which make up around 30% of my investment portfolio. Now, these stock market investments are passive investments and active investments. Passive investments are things that I just drip invest into, meaning every Wednesday I'm dollar cost averaging into a number of funds, which most of them are for cash flow, meaning most of them are paying out dividends because I like the cash flow. And then the other half of my stock market investments are more active investments, not trades, but investments where I believe that there's more growth potential because more money is moving into this industry. That's what I like to research. That's what I like to be involved with. It's just something I'm interested in, and I'm willing to take on that additional risk in the stock market. I have a whole team at Briefs Pro that works to publish that type of investor research into what we call Market Briefs Pro. That's separate from our free newsletter, Market Briefs, which I talked about a little bit earlier, but that's something that I'm just interested in. Some of you may completely hate that idea. Then the next piece is what I call speculative. And speculative investments make up around 18% of my portfolio. These speculative investments include things like the startups that I invest in, and it also includes cryptocurrency, which is a few cryptocurrencies that I have invested in. Now, notice where I have put cryptocurrency. Cryptocurrency for me is speculative. And so I put it in the speculative piece of my portfolio. The bulk of my investments are real estate and stocks. I didn't start investing into speculative assets until I had built a foundation in the time-tested assets, real estate and stocks. I know that those speculative assets can explode. I mean, I've been investing in cryptocurrency for a long time, and I've seen the prices of some of the investments that I've invested in go up a lot. But I also know that they can fall just as fast. And so for me, I throw them into the speculative bucket because I know that that's kind of the nature of what that is. And I've also taken some of those profits and dumped them into here, real estate, because this gives me cash flow that I could use to fund my lifestyle. So what is this last little piece? This 2% right here is physical gold, because for me that gold is an insurance, it's a hedge against doomsday, and it's a way for me to consider saving hard physical money, because my theory is if I bury some physical gold and some cash in my backyard today, that the gold would have more buying power in 10 years because of inflation. So that's what has worked for me. You got to come up with the right plan for you. Just understand that risk and reward. More risk means more upside potential, but also the potential to lose all that money even faster. Investing is risky, and you need to know the right strategy for you. Don't copy what I do, come up with the right plan for you, and hopefully this video helped give you a little bit more of a foundation of the different investment potentials that are out there. That way you can come up with a plan, because you don't have to invest in one, but you gotta start with one, and you need to know what is right for you. By the way, if you enjoyed this video, the best thank you is to share this video with somebody who you think will benefit. This is how the majority of Americans statistically manage their finances. Let's assume that you make, as a household, $60,000 a year, which is $5,000 a month. Now, who's the first person that you're gonna pay? It's not Chipotle and it's not Amazon. It's the government. Because if you're working a job